Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. In my most recent article, a reader posed a very interesting question that I felt compelled to at least attempt to answer to their satisfaction. The question was, someone please explain to me how valuation determines the future direction for dividend growth and total dividend payments for overvalued stocks. I've been asking this question for 5 years here on Seeking Alpha without a good answer. Nothing theoretical, please. I want to see actual data. Well, this really challenged me. I've been called Mr. Valuation by readers for many years now, and I'm all about investing at value. And valuation does have an impact. So in an attempt to answer this reader's question, I'm going to choose probably what I consider to be the most quintessential growth stock of all, Johnson & Johnson. And what I'm going to do is I'm going to look at it from a standpoint of investing in it and holding it for 10 years when it was overvalued versus investing in it when it was fairly valued and holding it for 10 years. So I'm going to start out by looking at the graph here. And I'm going to take the price and I'm going to take this blue line off the graph. And what I first want you to see is this has been a very consistent grower over all these years. And it's, AAA rated, moderate debt to capital. I'm not worried about current valuation. This is about looking at actual historical data and effect that valuation has. So I'm going to bring price onto the equation now. And what I'm going to do is I'm going to go back in time for the 10-year period that goes from 1998 to 2008. Now, we all might remember that 1999 and 2000 were classic examples. Ellen Greenspan at the time called this irrational exuberance. And there was a period where all stocks, especially tech stocks, but all stocks, including quality stocks like Johnson & Johnson, were trading at very high valuations. You can see here that the company was trading at a price of $41.94, but more importantly, the valuation was 38.8. Now, a couple of things I want you to notice when you look at this particular graphic here. I want you to see that the company's growth rate was 15.5%. Now, that's very important because this was a period where Johnson & Johnson was growing their operating earnings at a very high rate. So now we're going to look at performance. Now, I also want you to notice that if I bring on the dividend yield curve here, back at that period of time, Johnson & Johnson was only yielding 1.1%. So it was starting out with a current yield of 1.1%. So let's go ahead and look at performance and how the company performed and how the dividend performed. So if you'd have bought it at $41.94, I want you to notice you would have purchased 238.45 shares with a single one-time $10,000 investment. Now that's going to be important also because that's a lot of shares, 238 shares. Remember, during a time when the company was growing at 15%. So the first point is the dividend growth over this time frame, which I kind of cover in the article, was consistent with the company's operating achievement or operating earnings growth. The company's average dividend growth rate was 13.9% and its compound annual growth rate was 14%, or definitely in line with the 15% historical earnings growth achievement that the company had achieved during that time frame. Now, from a yield on cost perspective, the company's first year yield on cost was 1.3%. This is also important. Remember, they had 238.45 shares. So the first year's dividend would have been $129.95. And then their yield on cost, or their growth yield, I like to call it, increased 1.5, 1.7, 1.9. So the amount of dividend income that this particular investor would have received grew very nicely. It went from $129 to $428. That threw off a total of $2,581.24 in comparison to the S&P 500, which only paid 1,600 dividends or slightly more. So the point is, the total cumulative dividends during this time frame, buying the stock when it was overvalued, was $2,581. Capital appreciation turned $10,000 into $14,000, or growth, which averaged only 3.6%. And I want to make a point that is significantly less than the company's operating achievement. And one of the points I make over and over again is when you overpay for a stock, you no longer participate in the company's growth. You participate at a much lower rate and consequently or simultaneously are taking on much greater risk. Total return in this example is 5.4%. Now what I'm going to do next, I'm going to move this along I'm going to move this 10-year graph along to where we go from 2008 for the 10-year period that ends in 2018 here. And what we're actually, I'm going to go back one more year here, excuse me. It's the period 2009 through 2000 and into 2017. So I got a slight time difference here, but very close, just a few months off. I want you to notice that the earnings growth was only 6% during this time frame. However, if I look at the company, Johnson & Johnson was available at a PE of 13 during that time, and its starting yield would have been 3%, or almost twice what it was in my previous example. So now I've got a higher yield. I want to emphasize I've got a much slower growth rate of the business, but I got a much superior valuation by purchasing it. And of course, this is during the recession, I want to point out. But nevertheless, it's when the stock was fairly valued, which is the question. Well, how does overvaluation impact the future growth of my investment as well as the dividends? Well, in this case, I would have put $10,000 in. I'd have paid a much higher price, $59.83. That's because the company grew so fast during that first 10-year period. But remember, my valuation was significantly less, but I did buy less shares here, only bought 167 shares. In contrast, my original yield on cost was 3.2% or over 3%, but it grew dramatically over this time. My dividend income went from $322 all the way up to $554 last year. My total dividend income was $4,061, or substantially more than I received when I held it for 10 years when I bought it when it was overvalued. Additionally, my growth opportunity was 9.1%, and this is important because the stock was undervalued. Even though the company only grew by 6%, I actually ended up with an annualized growth rate of 9% or 50% higher than the company's growth, and my total return was 11%. And the point is, valuation has a major impact on the total amount of dividends that you're going to get. Now, for the growth of those dividends, as you saw in both cases, the first 10 years or the second 10 years, that is totally dependent on the growth of the company that you are investing in, and it's independent of whether it was overvalued or not. However, the total income is going to be directly related to how much yield you're getting in the beginning by buying a stock when it's low, when its valuation is low. And I want to close by simply saying this. The better investment here, the undervalued investment, was during a time when Johnson & Johnson grew slower and you actually bought less shares, but you still ended up with substantially more income and more total return as a result. This has been Chuck Carnival. I hope you enjoyed this video, and I hope it answered the question of my reader. If you're interested in learning more about fast graphs, contact us at the phone number on the screen right now, or email us at www.fastgraphs.com. Thanks for watching, and thanks for reading.